All right, let's dive into what might just be the biggest shakeup to financial reporting we've seen in a decade. It's a new standard called IFRS 18. And if you've ever looked at two company reports side by side and felt like you were comparing apples to oranges, well, this new rulebook is here to change all that.
You know the feeling, right? You're trying to figure out which company is doing better, but they seem to be speaking completely different languages. One is talking about its adjusted profit, the other is highlighting its underlying earnings. I mean, what do those terms actually mean? It really feels like you're missing a key piece of the puzzle.
And that right there, that's the heart of the problem we've been dealing with. For years, companies have been using these custom-made metrics, what are known as alternative performance measures, or APMs. The issue was they were totally voluntary and had no standard definition. It just created this fog of confusion that made real, honest, apples-to-apples comparisons feel almost impossible.
So you can imagine, this whole environment has been kind of like the Wild West. Every company got to make up its own rules for how it reported certain numbers, and it left investors and analysts just scratching their heads trying to make sense of it all. It was confusing, it was inconsistent, and it was definitely ready for a change.
And that change is finally here. IFRS 18 is basically the new sheriff in town, stepping in to bring some law and order to all this chaos. The whole point is to create consistency and transparency where, let's be honest, it was seriously lacking.
Okay, so what exactly is IFRS 18? In a nutshell, it's the new global rulebook for how companies have to present their financial performance. It's officially taking the place of the old standard, IAS 1. Its main mission is to bring some much-needed consistency to the profit and loss statement, making it a whole lot easier for all of us to understand.
So IFRS 18 really boils down to three huge changes. First, it's bringing in a brand new structure for the profit or loss statement, and it's mandatory. Second, it's laying down some strict new rules for all those custom metrics we've been talking about. And third, it's beefing up the principles for how companies group their information together. Let's break them down.
All right, first up, the new profit and loss statement. And let me be clear, this isn't a friendly suggestion, it's a required structural change for every single company that reports under IFRS. It forces them to sort all their income and expenses into one of three new, very clearly defined buckets. So that first bucket is the operating category. The easiest way to think about this, it's the heart of the business. All the money coming in and going out from what the company actually does day to day. It's also kind of the catch-all category. If something doesn't fit neatly into the other two, it lands here. Next up, you've got the investing category. This is for all the income the company makes from assets that generate returns on their own, separate from the main business. So we're talking about things like dividends from stocks they might own, or profits they get from a joint venture.
And last but not least, we have the financing category. This one's pretty straightforward, really. It's all about the costs that come with raising money. So things like interest payments on bank loans, leases, or bonds. Yep, they all go right in here.
Okay, so let's see how this all fits together. If you look at this simplified example for a bank, you can see how it works. Things like interest income and paying employees, that all goes into the operating section. And see that line, operating profit? That's new and it's mandatory. Then you add in the investing items, which gives you another new subtotal. And finally, you subtract the financing costs. The big thing to remember here is that this structure isn't optional anymore. It creates one consistent framework for everyone. Now, for the second massive change, taming those custom performance metrics. If the new P&L structure is like laying out a new orderly town grid, this is the part where IFRS 18 really cracks down on all that Wild West behavior.
So, before, we had what were called APMs, Alternative Performance Measures. But now we have MPMs, which stands for Management Defined Performance Measures. And trust me, the difference is night and day. What used to be a voluntary, often murky metric like adjusted profit is now a regulated MPM that's subject to mandatory disclosure and some really strict rules.
So you might be wondering, how does a company know if one of its pet metrics is now a regulated MPM? Well, it has to pass a four-part test. Is it a subtotal of income and expenses? Yep. Is it used in public stuff like investor calls? Yep. Is it a number that isn't already required by FIRS? Yep. And does it show management's view of performance? If the answer is yes to all four, then bingo, it's an MPM, and the new rulebook applies.
And those rules are all about one thing: transparency. No more hiding the ball. Companies now have to lay it all out in a single dedicated note. They have to explain why they use the metric, show exactly how they calculated it, and
This is the big one. They have to provide a reconciliation that connects their custom number back to the nearest official IFRS number, like operating profit. And get this, all of that information will now be audited.
But, like with any huge new set of rules, it's not all perfectly black and white. There are already some gray areas that are causing a lot of debate among accountants, and one of the biggest ones centers on a very specific kind of company. The whole debate is about these pure holding companies, the ones whose only real job is to own other companies. The question is, where does their income go? One side says, hey, their main business is investing, so that income should go in the operating bucket. But the other side says, hold on, based on the specific rules in IFRS 18, they don't technically count as an investment business, so their income has to go in the investing bucket. And believe me, while it sounds like we're splitting hairs, this can totally change what their operating profit looks like.
And this isn't just some academic argument, folks. This quote right here shows that this is a widespread, very real, and pretty urgent issue. Accounting bodies are getting pushed to give some clarity here because tons of companies have holding companies, and right now, there's just no single right answer.
Okay, so let's zoom out a bit. When you pull all this together, what does this big shift toward a more structured and transparent world actually mean for everybody?
Well, first things first, the clock is ticking. This all goes live on January 1st, 2027. Now, that might sound like it's a long way off, but for huge multinational companies, that's right around the corner. They are already working hard right now to figure out how to get their systems ready.
So what's the bottom line here? Well, if you're an investor, this is fantastic news. Comparing companies is about to get a whole lot easier. If you're running a business, well, get ready, because your custom metrics are about to be put under a microscope. And for everyone else, it's a huge step toward financial clarity, even if there are still a few gray areas, like that holding company debate, that need to get ironed out.
Which leaves us with one big final question. IFRS 18 is this massive effort to bring order and transparency to the financial world. But will these stricter rules actually give us the clarity we're all hoping for? Or did we just challenge accountants everywhere to get even more creative in how they do things? I guess only time will tell.